China is the world's second largest economy and has long played a crucial role in global growth. However, recent indicators suggest that the country is facing significant economic challenges. With growth falling short of expectations, the real estate market in a slump, and a rise in youth unemployment, international leaders and investors are increasingly concerned about China's recent economic slowdown, with experts now questioning whether the world's second largest economy could collapse. In this video, we will explore the current state of China's economy, the factors that have led to its potential collapse, and what it means for the country and the world. But before we dive in, take a moment to smash that like button and subscribe to our channel. China's economy has grown to become one of the world's largest and most powerful in recent decades. The country transformed from a struggling nation, heavily affected by the Second World War and its civil war in the mid-20th century, to the second largest economy globally, surpassing Japan in 2010. This remarkable growth signaled China's genuine rise as an economic superpower. It also indicated that the rest of the world will have to acknowledge its status. China has steadily opened its economy over the years, leading to significant improvements in economic development and living standards. The government's gradual shift away from collectivized agriculture and industry not only increased market price flexibility, but also allowed greater autonomy for businesses and fueled significant growth in both domestic and foreign trade and investment. All this, alongside China's strategic emphasis on domestic manufacturing, solidified the country's position as the world's top exporter. With consistently higher annual growth rates than the United States, there was speculation that China might eventually surpass the United States as the world's largest economy. However, despite its significant achievements, China is currently facing substantial economic challenges. Economists currently view China as entering a phase of notably reduced growth. This situation is aggravated by unfavorable demographics and an increasing divide with the United States and its allies, which is posing a threat to foreign investment and trade. While some experts consider this to be a temporary economic downturn, others speculate that it might signify the end of an extended period of robust growth. In July, China's economy officially slipped into deflation for the first time in 2 years as consumer prices fell 0.3%. All this contrasts with the rising living costs that the rest of the world is facing. And while the average consumer might find lower prices appealing, economists consider deflation a negative indicator for the economy. Prices falling over a long time leads to consumers spending less and companies reducing production, which in turn leads to job cuts and lower wages. The Chinese economy experiencing deflation is raising concerns about its post-pandemic recovery. China was expected to recover strongly after lifting its strict zero COVID restrictions late last year. However, its rebound has been unimpressive. A lot of major banks have revised their 2023 gross domestic product (GDP) growth predictions for China due to concerns about a slowing post-COVID recovery. They believe that without additional stimulus, China may struggle to reach its targeted 5% growth this year. In the country, consumers remain cautious about spending following extensive lockdowns, which has hindered the economy's much-needed boost in consumption. In August, the Chinese yuan hit its lowest value in 16 years, causing anxiety among investors about the country's economic state. In response, the People's Bank of China adjusted the currency's rate to a level higher than its estimated market value. China's trade also faced unexpected challenges in July, with imports dropping by 12.4% year-on-year and exports dropping by 14.5%, as global demand for Chinese products waned. Additionally, China's stock market experienced difficulties, with Hong Kong's Hang Seng Index (HSI) falling into a bear market after a more than 20% decline from its January peak. The country's unemployment rate has also recently reached record highs, prompting the country to suspend data releases on youth unemployment. China's real estate sector, which has thrived in past decades and accounted for over a quarter of the country's economic activity, has also faced significant challenges since the pandemic. The crisis deepened due to new borrowing regulations implemented in 2020 to curb the housing market and prevent a bubble. Heavily indebted developers in China, who played a crucial role in the country's economic growth in past decades, are now facing challenges due to the new borrowing regulations. These rules left many highly indebted developers struggling to repay investors. This situation is exemplified by the recent troubles of Country Garden, formerly China's largest property developer, which is now on the verge of default after missing $22.5 million in coupon payments in August. Similarly, Zhongrong Trust, a significant investment trust managing $87 billion in funds as of the end of 2022, has reportedly failed to make $15 million in payments to corporate investors. These issues have raised concerns about a potential liquidity crisis that could have broader financial repercussions in China. Amidst challenges faced by real estate developers due to a slowing market, local governments find themselves losing money on land sales and accumulating significant debt. This debt adds strain to Chinese banks and diminishes the government's capacity to enhance public services, thereby increasing the risk of a financial crisis in the nation. Land sales contribute significantly to local government revenues. As of 2022, China's outstanding government debt exceeded 123 trillion yuan or $18 trillion. Nearly $10 trillion of this debt falls under the category of hidden debt, contracted by local governments through financing platforms supported by cities or provinces. Also, earlier this year, China lost its status as the world's most populous country to India, a position it held for centuries. This change has significant implications for the Chinese economy, which has relied heavily on its large workforce. The country's population growth has not only slowed, but is expected to decline even further in the coming decades. The working-age population, which peaked in 2011 with over 900 million people, is projected to decrease by nearly a quarter to around $700 million by mid-century. These workers will face the responsibility of supporting nearly 500 million Chinese citizens aged 60 and over, in contrast to the current 200 million. This demographic shift in China will result in a reduced workforce and a larger elderly population that requires care. While some people might think that the recent economic troubles in China are solely China's concern, if China's economy were to collapse, it would impact both the nation and the world. China holds a prominent position in various global sectors, and the International Monetary Fund's IMF's latest World Economic Outlook forecasts that it will contribute more than 22% of the global gross domestic product, GDP. Despite its reputation, China is a significant bilateral trade partner for many countries and a leading provider of goods, earning it the title of the world's manufacturing hub. Most major global companies have their supply chains based in China, including Tesla and Apple. China is the world's largest manufacturer and exporter of goods. It is also the biggest consumer of various key commodities like metals. This impacts commodity exporting countries significantly. China consumes a significant portion of the world's oil, copper, nickel, zinc, and iron ore. A slowdown in China's economy will lead to reduced demand for these supplies, affecting countries like Zambia and Australia. Additionally, some Western companies rely on China for a substantial portion of their revenues. In 2021, the top 200 multinational firms in the US, Europe, and Japan generated 13% of their sales in China, totaling $700 billion. A decline in China's economic activity can disrupt the global supply-demand balance, which is concerning as the world is recovering from an economic slowdown caused by factors like inflation, the Russia-Ukraine conflict, and extreme weather events. A collapse in China's economy could also have significant geopolitical implications. It could lead to a shift in the balance of power, as China's influence in the world would decrease. If the slowdown doesn't turn into a major crisis, the discomfort will primarily affect a specific group. However, a question that the world has yet to get a clear answer to is whether China's economy is likely to get back on track. While nothing is sure, there is a high chance that China's economy could stabilize at a slower pace soon, but we will have to wait and see. Do you think this is short-term and China's economy will recover soon? Share your thoughts in the comments section below. Also, don't forget to give this video a like and subscribe to our channel if you're yet to do so. We'll see you in our next video.